Inflation is not an abstract economic concept. It is a daily reduction in purchasing power. Prices move, wages and benefits may lag, and your savings can quietly lose value even if the account balance looks stable. If you are trying to protect your finances in 2026, the most useful question is not, will inflation go up or down? It is, which asset types have historically helped investors preserve real value when inflation is elevated or uncertain? Below is a macro, data-informed framework written for a general audience that highlights 3 asset classes often viewed as stronger inflation hedges. This is analysis and education, not personal financial advice.
The inflation problem. Why normal savings can feel safe but behave dangerously.
Think of inflation as a slow leak. Your money stays in one place, but the cost of everyday items rises around it. For example, if inflation averages 4% over a year, a balance that stays the same effectively loses about 4% of purchasing power.
If inflation is higher, the loss compounds faster. If inflation stays elevated longer, the gap between nominal returns, the number you see, and real returns, what you can buy, widens.
Even if interest rates are higher than in the low-rate era, savings accounts and short-term cash instruments can still underperform inflation, especially if inflation proves sticky or rebounds. That is why many investors shift focus from nominal returns to real value protection, asking whether an asset's behavior historically improves when prices rise. Asset number 1. Equities with pricing power, quality factors. When inflation rises, not all companies are hit equally. A business with pricing power can often raise prices to match or partially offset higher input costs, meaning its profits may be less squeezed by inflation than a business that must accept fixed prices. What pricing power typically looks like, in plain terms? You tend to see it in companies with strong brands or customer loyalty. Demand holds up even as prices rise. Operational strength, efficient production, disciplined cost controls. Reasonable leverage, less vulnerability when financing costs rise. Consistent cash flow, fewer survival mode moments during economic stress. Why investors often emphasize quality factors during inflationary regimes. Quality is not a single stock, it is a way of selecting companies. While definitions vary, the common theme is that these businesses have stronger balance sheets, show more resilient earnings, and may sustain dividends or reinvestment through tougher cycles. A macro perspective, inflation interacts with corporate fundamentals. In inflationary environments, the market often rewards companies that can pass costs to customers, maintain margins, and avoid balance sheet strain. Meanwhile, companies that rely on cheap input costs or face intense pricing pressure can see profitability compress, even if the headlines mention revenues are up. Key idea. In many historical periods, equities are not automatically a perfect inflation hedge, but a subset, companies with pricing power and quality characteristics, has often behaved more defensively than the broad market. If you approach equities as an inflation-aware allocation, it is often more thoughtful to think in terms of business resilience and the ability to manage inflationary cost pressures rather than simply chasing whatever sector is trending. 345. Asset number 2. Commodities and real assets, the tangible hedge. Inflation is sometimes driven by real-world constraints. Energy supply disruptions, shortages of critical inputs, weather events affecting crops, geopolitical friction affecting shipping routes, and industrial demand outpacing production. When inflation is tied to physical scarcity or supply shocks, that is where tangible assets can be influential. Why real assets can help during inflation spikes. Commodities and real assets often have 2 characteristics that matter for inflation. Their prices frequently react to changes in supply and demand in the real economy, not just to interest rate expectations. They can reflect broader inflation pressures when goods and inputs become more expensive across sectors. For example, if energy becomes scarce or more costly to produce, transportation and production costs often follow. If metals face supply constraints, industrial activity and construction costs can reprice upward. The important nuance: real assets are not one trade. This is where macro context matters. Commodities can be influenced by global growth expectations, currency movements, inventory cycles, and commodity-specific supply dynamics.
They can also be volatile and subject to sudden reversals. Key idea: real assets are often viewed as an inflation hedge because they are tied to physical goods and production inputs, but they are not designed for stability like cash.
Their role is commonly more about inflation sensitivity and portfolio diversification than about smooth returns. How this fits into a 2026 framework. If inflation is shaped by supply constraints or renewed commodity stress, real assets may better align with the source of the price pressure. If inflation is mainly driven by demand overheating that then cools quickly, the relationship can weaken. That is why diversification across multiple inflation channels is a central theme. 610. Asset number 3. Treasury Inflation Protected Securities. Tips. If equities and commodities represent economic channels, business pricing and physical scarcity, TIPS represent a direct inflation link. TIPS are designed so that the principal value adjusts with inflation based on a recognized index, which means you are not purely relying on the market to guess inflation correctly, and your investment is structurally tied to inflation changes. Why TIPS are often used as a built-in inflation exposure. Inflation protection is not a promise of profits. It is a mechanism. The mechanism matters. In simplified terms, TIPS adjust with inflation, aiming to preserve purchasing power. Your return is influenced by both the inflation adjustment and the real yield level, the yield after removing expected inflation. Macro perspective: what TIPS respond to. TIPS pricing can still move because of changes in real interest rates, the compensation for lending in real terms, shifts in inflation expectations, and broader market risk sentiment. So TIPS can experience fluctuations, but the inflation indexing feature is fundamentally relevant when the economic question is, will my returns keep up with price growth? Key idea: TIPS are often viewed as one of the most straightforward ways to anchor a portfolio to inflation outcomes, especially when investors want a clearer linkage to inflation readings rather than relying entirely on market interpretation. 830. How to apply this strategy. A simple, macro-driven blueprint. At this point, you may be thinking, how do I translate this into an actual plan without overcomplicating it? Here is a general structure you can use to connect macro analysis to portfolio decisions. Again, educational and not personal advice.
Start with the problem you are solving. Purchasing power, not headlines. Inflation hedging is ultimately about real value. Before choosing assets, clarify. Are you mainly trying to reduce the impact of inflation on essentials? Are you planning for medium-term costs, 1 to 5 years, or long-term goals, 5+ years? How would you feel if a hedge asset experiences temporary drawdowns?
Different horizons often lead to different acceptable trade-offs between inflation sensitivity and price stability. Diversify across inflation drivers. A helpful macro lesson is that inflation does not come from one source only. If inflation is driven by company costs and customer pricing, pricing power equities may be relevant. If inflation is driven by supply constraints and physical scarcity, real assets and commodities may help. If inflation is driven by broad price growth that you want tracked structurally, inflation-linked bonds such as TIPS can be useful. Thinking in terms of drivers encourages more robust allocation choices than trying to predict a single inflation outcome. 3. Use position sizing with risk in mind, especially for volatile hedges. Real assets and commodities can be volatile. Equities can reprice quickly as rates and growth expectations change. TIPS can move with real yields. That does not make them bad. It means inflation hedging that often involves accepting that some hedges may not look calm in every month or quarter. A disciplined approach typically avoids over-concentrating in one hedge category. Reassess as the inflation story evolves, not constantly, but with purpose. Macro conditions shift. You may see inflation decelerate, inflation become more variable,
or inflation concerns return as new shocks emerge.
A practical rule of thumb for many investors is to review periodically rather than react daily to headlines, because overreaction often turns hedging strategies into chasing strategies. 5. Pair inflation protection with portfolio purpose. Inflation hedging is not the only objective. Liquidity needs matter, risk tolerance matters, and goal timing matters. A comprehensive plan typically separates what must be stable, what can be diversified, and what can be allowed time to work. Bringing it all together, the 3-asset framework for 2026. If you want a concise summary of the macro logic: 1. Equities with pricing power, quality factors, potential to maintain margins and earnings resilience when costs rise and prices need to be passed through. 2. Commodities and real assets, exposure to physical goods and supply-demand pressures that can drive inflation during real economy shocks. 3. Tips, structural linkage to inflation measures, helping preserve purchasing power rather than only relying on market forecasts.
None of these assets is a guaranteed always wins solution. Inflation itself is not a single phenomenon. It can be supply-driven, demand-driven, policy-driven, or all three at different times. The value of this framework is that it approaches inflation as a macro challenge with multiple transmission channels.
Suggested takeaways you can act on today. Education focused.
Educate yourself on how inflation affects real returns, not just nominal numbers. Evaluate whether your current holdings are primarily suited to stability, growth, or inflation sensitivity. Consider whether your inflation exposure is diversified across pricing power businesses, tangible real assets, and inflation-linked securities. Review your plan with a longer-term mindset, recognizing that hedges can move. Timestamp links recap. 00. The inflation problem. 125. Asset number 1. Equities with pricing power, quality factors. 345. Asset number 2. Commodities and real assets, the tangible hedge. 610. Asset number 3. Treasury inflation-protected securities, tips. 830. How to apply this strategy.
If you are navigating 2026 with inflation risk in mind, the most valuable mindset is not fear, it is clarity. Inflation can reduce purchasing power, but with a macro framework and informed asset selection, you can build a portfolio approach designed to withstand price pressure rather than simply react to it.